It is currently Sunday, December 14, 2025. The markets are closed. Microsoft Corporation, trading under the ticker symbol MSFT on the Nasdaq, finished the last trading session on Friday at exactly $478.53 USD, down 4.94 points, or negative 1.02% for the day. While the screens are dark right now, the aftershocks of that Friday close are still reverberating through the weekend analysis notes of every major desk from London to New York. Seeing a trillion-dollar titan like Microsoft shed nearly $5 a share in a single session isn't just a fluctuation, it is a statement. If you are looking at that red percentage and thinking it's just a minor blip in a steady upward march, you are missing the far more aggressive undercurrents currently tearing through the technology sector. The expectation, the comfortable lie that most retail investors tell themselves, is that Microsoft is the safe tech stock, the boring utility of the digital age that simply compounds at 10% forever. The reality, however, is substantially more volatile and dangerous. We're watching a company that is currently burning through capital expenditure at a rate that would bankrupt small nations, all to win an artificial intelligence war where the profit margins are still theoretical for many. That drop to $478.53 USD isn't just selling, it is a repricing of risk in a market that is suddenly terrified that the AI return on investment might be further away than the frantic press releases of 2024 promised. When you look at the intraday action from Friday, the weakness was systemic. The stock opened near 483 USD, attempted a weak rally, and then was methodically sold off throughout the afternoon session. This wasn't a panic dump, it was institutional distribution. High-frequency traders and algorithmic systems on platforms like Interactive Brokers stock trading terminals were flagging elevated sell-side pressure every time the stock tried to reclaim the 480 level. It is crucial to understand the psychology here. When you see a slow bleed day like Friday, where the stock finishes near its lows, it usually indicates that large asset managers, the people managing Fidelity investments and massive pension funds, are trimming positions. They aren't exiting, they're reducing exposure because the risk-reward ratio has shifted. The volume on Friday was consistent with this theory, coming in slightly above the 20-day average, suggesting that this wasn't just retail noise. If you're sitting at home using Robinhood stock trading to buy fractional shares, you might see a dip and think discount, but the professionals using Interactive Brokers trading suites are looking at a double top formation on the weekly chart that signals exhaustion. The stock has banged its head against the 500 USD ceiling multiple times this quarter and failed to break through. In technical analysis terms, this is a classic rejection. The market is screaming that it does not believe Microsoft is worth more than $3.6 trillion right now, not until it sees concrete proof that the billions being poured into data centers are actually turning into free cash flow. This brings us to the broader context of why Tesla stock, Apple stock, and Nvidia stock are all dancing to this same erratic rhythm. We are in late 2025 and the AI fatigue is real. For the last 2 years, the narrative was simple: buy GPU makers and buy the cloud providers who buy the GPUs. But now we are in the show me the money phase. Microsoft's recent Q1 FY 2026 earnings showed revenue of $77.7 billion. That's a massive number, but the market didn't cheer, it shrugged. Why? Because the capital expenditures, the money spent on building those massive server farms, spiked to nearly $35 billion in a single quarter. To put that in perspective, Microsoft is spending more on infrastructure in 3 months than many Fortune 500 companies earn in a decade. When you're an individual investor, perhaps managing your own retirement through Schwab Intelligent Portfolios, you need to ask yourself if you are comfortable owning a company that is effectively betting the entire farm on a technology shift that is still evolving. That drop to $478.53 USD isn't just selling, it is a repricing of risk in a market that is suddenly terrified that the AI return on investment might be further away than the frantic press releases of 2024 promised. Let's pause for a moment and consider the retail landscape, because the disconnect between Main Street and Wall Street on Microsoft is fascinating. If you look at the chatter on SoFi Invest social boards or the Robinhood app feeds, the sentiment is overwhelmingly bullish. Buy the dip is the mantra. Retail traders look at Microsoft's dominance in enterprise software and assume it's invincible. They see the Robinhood fractional shares feature as a way to accumulate a piece of this empire for as little as $1, and they keep buying. But compare this to the flows we are seeing in Fidelity mutual funds or Fidelity wealth management accounts. The smart money is rotating. They aren't selling out of tech entirely. They are moving into sectors that benefit from the current macroeconomic setup: industrials, financials, and defensive staples. They are using Fidelity ETFs to hedge their tech exposure. This divergence creates a dangerous trap. When retail investors are buying a falling knife that institutions are letting go of, the floor can drop out much faster than you anticipate. If you are engaged in self-investing or online investing without paying attention to these institutional flows, you are flying blind. You might think you are investing in a blue-chip stock, but you are actually stepping in front of a freight train of institutional profit-taking. Now, let's establish some common ground before we rip the thesis apart again. Microsoft is undeniably a beast. It is not going anywhere. The core thesis, the expectation, is that between Windows, Office 365, and Azure, the company has an unassailable moat. And this is true. If you work in a corporate environment, you live in Microsoft's ecosystem. You use Word, you use Teams, your back end runs on Azure. This stickiness is why investment advisors have recommended this stock for decades. It is the reason why Schwab Intelligent Portfolios will almost always have a chunk of MSFT in their growth and balanced models. The recurring revenue from Office 365 is arguably the best business model in the history of capitalism. It is a tax on doing business. You cannot stop paying it. This gives the company a floor that stocks like Tesla simply do not have. Tesla has to sell you a new car every few years. Microsoft just charges your credit card every month forever. This predictability is why Fidelity IRAs are packed full of Microsoft shares. It is the anchor of the American retirement account. However, the reality in late 2025 is that this anchor is being dragged into a storm. The core business is slowing. The PC market is saturated. The only real growth engine left is Azure and AI, and here is where the deeper analysis gets worrying. Search results and industry reports from this week indicate that Azure's growth, while still impressive at 30 to 40%, is facing stiffer competition than ever. Amazon Web Services is fighting back with its own custom silicon, and Google is aggressively pricing its cloud services to win market share. Furthermore, the adoption of Copilot, Microsoft's AI assistant, is reportedly slower in the enterprise space than the bulls hoped. Companies are testing it, yes, but are they deploying it to 100,000 employees at $30 a seat? Not as fast as the stock price demands. The AI tax that Microsoft wants to levy on the corporate world is facing resistance from CIOs who are tightening their belts. This is the friction point. The stock is priced for perfection. It is priced as if every office worker in the world will pay for Copilot. If that adoption curve flattens, the stock has a long way to fall to reach a fair value based on traditional metrics. We also have to talk about the macroeconomic backdrop of December 2025. The Federal Reserve just cut rates for the third time this week, trying to stick a soft landing. Normally, rate cuts are good for tech stocks because they lower the discount rate in those fancy discounted cash flow models that analysts at Interactive Brokers stock trading desks use. But this time, the cuts are coming with a warning: inflation risks are tilted to the upside. The potential for new tariffs and trade wars is reigniting inflation fears. If inflation spikes back up, the Fed will have to stop cutting or even hike again. This uncertainty is poison for high-valuation stocks. When you invest online, you are implicitly making a bet on interest rates. If rates stay higher for longer, the future cash flows of Microsoft, which are huge but far in the future, are worth less today. This is why you see days like Friday where a good news, a rate cut, results in a sell-off. The market is looking past the cut and seeing the inflation dragon waking up. Speaking of engagement, I want to pause here and ask you a question that really matters for your portfolio. Comment below with how many shares of Microsoft you currently hold, and more importantly, tell me if you are using a robo-advisor like SoFi Robo-Advisor, or if you are picking stocks yourself via an individual brokerage. I'm genuinely curious to see if the passive investors are holding strong while the active traders are selling off. And do you think Copilot is actually useful, or is it just a gimmick? Let me know in the comments. Now, let's shift gears to the technicals and the specific tools you might be using. If you are on a Fidelity mobile app or the Fidelity trading platform, you have likely seen the bearish signals flashing on the summary page. The 50-day moving average is dangerously close to crossing below the 200-day moving average, a death cross in the making if this slide continues for another month. Support is sitting right around 470 USD. If MSFT breaks 470, the next logical stopping point is 450 USD. That's a significant drop from here. For those of you using Interactive Brokers' fee structures to trade options, you may have noticed the spike in put buying. Traders are hedging.